Well, good morning, and look where I am. Yes, I am at the Money Show here in Orlando, Florida. I will be speaking today at 3 to 3:30, talking about navigating this market into year end and into what's coming up as the election year. Anyway, today is Tuesday, October 30th, 2023, and I am Kenny Polcari, your host of the party, and here is what you need to know to get your day started, right? So now on Friday, the S&P officially enters correction territory, right? The correction zone, leaving only the Dow trading in the normal zone, right? All the other indexes are now in correction territory. The Middle East conflict over the weekend did not go into overdrive, right? So this morning oil's lower, gold's a little bit steady, and stock futures are pointing higher. Treasuries continue to churn, right? But the path of least resistance is higher for Treasury yields, which means I still think bond prices are going lower. And what do we have for dinner tonight? Well, we're gonna have the quick and easy spaghetti and meatballs. Should take you no more than 1 hour max to make, and it is so delicious. Okay, look, it got ugly on Friday as the day came to a close and the weekend came upon us. Some of the weakness, a direct result of the uncertainty that was gonna head into the weekend, right, concerning the Middle East conflict. Some of it was due to the ongoing correction that is now engulfing all of the indexes, except the Dow, and some of it due to the ongoing uncertainty taking place in Washington now that we have a new House Speaker. So what does that really mean, right, for the government, for the markets, and all that? The S&P is the latest index to give it up. Right now, it is now down more than 10% off the July high, joining the NASDAQ, which is down 12.5%, and the Russell and the transports both down 18% as they get ready to kiss the bear market territory. The only index, like I said, that is not in correction territory is the Dow. That's only off about 8% from the summer high. Look, gold tested and pierced $2,000 an ounce. In fact, it traded all the way up to $2,019 an ounce before ending the day at $1,988. The recent surge higher can be tied directly to the Middle East outbreak, right? Surging nearly 10% just in the last 3 weeks as the ultimate safety play. I like gold, right? I still think it's going to go higher. I think we're going to see prices higher in the weeks ahead. I think, 2,100 would not be out of the question, and that's about a 5% move from here. The dollar index is holding steady at 106.45, so let's watch and see what that does. Any higher yields will strengthen that dollar. Oil ended the day higher on Friday, closing at 85.50 as the week came to a close and the angst rose across the Middle East, right? About what was going to happen over the weekend. This morning, oil is down $1.50 to 84.10 after speculation builds that the conflict will remain contained, even as Iran suggests otherwise. The issue now is what will Syria, Lebanon, and even Turkey do should the Israelis move deeper into Gaza, which then leads to the next question. What will we do? What will China do? And then what will Russia do? Treasury yields continue to be erratic from one day to the next as they try to find some stability, right? On Friday, they ticked slightly lower on the back of the economic data that left many wondering what's next, right? We got a stronger personal spending. We had a confused PCE report. That's the Fed's favorite inflation gauge. We had an uptick in the 1-year and the 5-year inflation expectations out of the University of Michigan, all causing renewed angst for investors. Friday afternoon left the 2-year yielding 5%. The 10-year was 4.83%, and the 30-year was 5.01%. Look, the U.S. bond market has come under intense pressure and volatility amid the speculation of higher rates, right? Along with the idea that the Fed is going to have to bring an enormous amount of bonds to the market to pay for all the bills caused by the reckless spending by this current administration. So go back to Econ 101. More supply means lower prices and higher yields. I still think bonds are going lower in the months ahead before they stabilize. Not dramatically, but I do think we're going to see some more downward pressure. I think rates are going to somewhere settle between 5 and 5.5. So prepare yourself for those higher rates. Look, Wednesday's Treasury Department bond sales announcement is potentially an even bigger event than the FOMC. Why? Because it is going to reveal what the Treasury will need to sell in order to continue to fund this massive budget deficit, and that could see bond prices decline. This morning's yields are all teasing just a bit higher from where they were at the end of last week, right? We're also going to get a bunch of earnings from nearly 75 company reports this week with a range of macro data points. We're going to hear from Apple, McDonald's, Simon Properties, Rig, Caterpillar, Amgen, Pfizer, AMD, Humana, CVS, Qualcomm, PayPal, Lilly, and many, many more. On the economic front, we're going to get the ADP employment report expected to be up 150,000 new jobs. Housing price data, manufacturing and services PMI, both expected to be in expansionary territory, not something that the Fed wants to see at all. We're going to get construction spending. We're going to get the FOMC rate decision, which is a pause. We already know that. Labor costs, factory orders, durable goods, and Friday's key data point, the October non-farm payroll report, which is expected to show a gain of 190,000 new jobs. The unemployment rate is expected to remain at 3.8%. Average hourly earnings month over month up 0.3, while year over year average hourly earnings are up 4%. The VIX, which is the fear index, ticked higher on Friday, was up about 3% as fears resurfaced on news that the Israeli Defense Forces were expanding their move into Gaza, while Hezbollah and the Houthis threatened further action, all supported by Iran. The VIXI ETF rose 3.25%. The SH, which is the S&P short, rose by 0.5%, and the DOG rose by 1.2%. The PSQ, in fact, fell because that's the NASDAQ short, and the NASDAQ actually bucked the trend and rose by 47 points on Friday. This morning, U.S. futures are ticking higher, and the weekend did not see an all-out invasion of Gaza. In fact, the Israelis are proceeding more cautiously, allowing even more humanitarian aid into the region. Now, instead of that promised massive ground invasion, Israel has opted to go slowly to avoid even larger civilian casualties, even as the goal is to destroy Gaza to ensure that Hamas has nothing left. Now, which doesn't mean that they're going to eliminate it. They won't. And this conflict is only going to embolden the Iranians, the Syrians, and a host of other Arab nations. What is amazing, though, is that more than 1 million Gazans have been displaced, yet not one Arab nation is opening its doors. One, because they don't want the problem, and two, because they don't want the problem, right? They just don't want it in their borders, so they're keeping their borders tightly closed, and that includes all the surrounding Arab nations. At 6 o'clock this morning, the Dow futures were up, right? Up 150, the S&Ps were up 25, the Nasdaq's up 115, and the Russell's ahead by 15 points. Now, some of this is a direct result of the short-term oversold condition, with buyers scanning the landscape for opportunities and names that have become dislocated for no other reason than large asset managers are using them like ATMs. Think the Magnificent Seven: Apple, Amazon, Nvidia, Meta, Tesla, Microsoft, and Google, all big mega cap names that have come under some pressure. So you got long-term investors thinking, is this the time? Maybe I should jump in and buy some. From a sector perspective, we've also seen money come out of the consumer discretionary sector over the past 6 weeks, right? Leaving that sector is only up now 16%. That's great. But look, 6 weeks ago, it was up 34%, right? So we've seen an 18% decline, which should surprise nobody, especially if you're in the camp that thinks it's only going to get harder in the months ahead. In addition, we continue to see weakness in utilities. The XLU was down 1.9% on Friday, leaving it now down 16% year to date, as investors in that sector expect higher rates ahead. Many investors, remember, buy utilities because they are boring, right? But they are defensive, and they offer decent dividend yields. But higher treasury yields, money market, and CD rates make utility dividends less attractive, right? Thus the pressure. We also saw big declines in healthcare, down 1.7, financials down 1.8, consumer staples was down 1.4, which is illogical to me. Energy gave up 2.4%. There is now more than $6 trillion in money market funds, as some investors are selling stocks and putting that money aside. 5% guaranteed is very attractive in a very uncertain environment. But remember, it also suggests future demand for stocks when investors feel less anxious, as does, by the way, the total short interest in the markets. Remember, investors who go short stocks expect them to go lower, but at some point, they must buy back those stocks in order to close out the position, and that short interest actually reflects future demand as well. So rising short interest can actually be a contraindicator, and guess what? Short interest is rising. Now, stocks in Europe are all higher this morning. Markets across the region are better than 0.6%, the move being credited to that lack of that massive ground invasion in the Middle East. The Bank of England is also due out with their latest policy statement on Thursday, and the week is going to be full of European company earnings as well, right? So we're kind of in the middle of that ongoing earnings season. In any event, The S&P closed down 20 points or 0.5% on Friday, leaving it now at 41.17. It is now down 10.75% off the July high. The long-term trend line at 42.40 now represents resistance for the S&P. A quick rally back to that level would not be out of the question, but I suspect that it's going to find plenty of resistance once it gets there. A look at the chart now suggests that a test lower, potentially to 39.50-ish, is not also out of the question, leaving some to ask what happened to the Santa Claus rally. Well, my sense is that we're going to get a little bit of one, just not the rally many thought that it might be, which just means be prepared, don't be surprised, remain short-term cautious while always remaining long-term optimistic. Keep building up your cash position if you're anxious, which is paying, 5+%. I would not be selling good stocks. I would, though, hedge your portfolio with some of the contra trades if you're nervous. So the VIXI, the SH, the PSQ, the DOG, right? If you're really concerned. But I wouldn't be selling, and I'm not selling my good names. Now, in any event, it's the economy that's going to make a difference in the long term. The full impact of the 11 rate hikes by the Fed, along with the rate hikes by the other central banks around the world, have yet to be completely felt by the global community, right? And even if we pause, which we're going to do on Wednesday, JJ has made it very clear that those rates are going to remain higher for longer, and that has a potential to remain a headwind for stocks in the months to come. Okay, so what do we have for dinner tonight? Well, this is simple. I made this the other night. I actually put pictures up on my Twitter so you can find it. My Twitter is at Kenny Polcari. It's a quick and simple spaghetti sauce with meatballs. When I tell you this is so delicious, it doesn't take anything like when you think of spaghetti and meatballs. So for this you need, the whole thing maybe takes you 1 hour, start to finish. So for this you need leeks. Leeks is the key here. You need a can of kitchen-ready crushed tomatoes, salt, pepper, olive oil, fresh grated Parmigiana cheese for the sauce. For the meatballs, you need 1.5 pounds of ground chuck, right? The 80-20 mix. You want 20% fat. Anything less than that, they're going to taste like cardboard. You need 1 egg, which you beat. You need Italian bread that you've chopped, into chunks, and then you soak it in whole milk. You need 3 grated garlic cloves. You need Parmigiana cheese, chopped parsley, salt and pepper, and you need 1/2 pound of spaghetti. You're going to bring a pot of salted water to a rolling boil, leave it on the back burner, just so it's ready when you need it. Now, start by making the meatballs. Take all those ingredients I gave you, mix them all together, squeezing the milk out of the bread before you add the bread to the meat, and then mix it really well, season it, and then form them into little golf ball sized meatballs, right? Put them in the pan, brown them by frying them, and then remove it, leaving the oil in the pan. Now, using the same pan, you're not going to clean it. You're going to add the sliced chopped leeks, right? You're going to use the white to the light green part of the stock. You're going to saute it until it's nice and soft. Now you're going to add the can of tomatoes, the salt and pepper, and about 1/2 can of water. Bring it to a boil and then reduce the heat to low. Add back those meatballs and let it all simmer for 20 minutes. Now, add the spaghetti to the water, cook it for 8 minutes or so. You want it al dente. And while it's cooking, you want to remove the meatballs from the sauce, just leaving the sauce in that saute pan, right? Set the meatballs aside. Now, when the pasta is ready, using tongs, take the spaghetti out, put it directly into the saute pan that's got the spaghetti sauce in it. Toss it to coat so the spaghetti's all nice and coated. You can add a handful of grated Parmigiana cheese. Toss it again just so that it's all coated. You want to serve it now individually in warm bowls, and then you want to top it with 1 or 2 of those meatballs, right? That's it. It's done. It's delicious. It's simple to make. It's going to become a family favorite. Look at the picture on my Twitter and you'll see. In any event, I'm speaking here at the Money Show at 3 o'clock today from 3 to 3:45. If you're not here, I wish you were here. There are plenty of people here. There's a lot going on here at the Money Show. In any event, until tomorrow, have a good day.